If you receive the UK state pension, the news coming out of the Department for Work and Pensions this week could put extra money in your pocket starting this April. The confirmed increase is larger than many people anticipated, and I want to make sure you understand exactly what it means for you. Many pensioners miss important changes simply because they do not hear about them in time. If you want to stay informed about updates that affect your pension and benefits, subscribing to this channel is the easiest way to make sure you never miss an announcement that matters to your income. Today, I am going to walk you through everything you need to know about the April 2026 state pension increase. I will explain how much more you will receive when payments begin and the key differences depending on when you retired. I will also cover some important details about tax, national insurance records, and additional benefits that many people overlook. Let me start with what has been officially confirmed by the Department for Work and Pensions. From April 2026, the state pension will increase by 4.1%. This rise applies under the triple lock guarantee, which has been government policy since 2010. The triple lock means the state pension rises each year by whichever figure is highest among three options: the rate of inflation, the growth in average earnings, or 2.5%. For April 2026, average earnings growth came in at 4.1%, which was higher than both inflation and the minimum floor of 2.5%. This means your state pension is increasing in line with what working people are earning across the country. It is worth noting that the inflation figure used for comparison was around 1.7%, based on the September 2025 measurement. So the earnings figure delivered a noticeably better outcome for pensioners this year. Now, let me explain what this increase means in actual pounds and pence, starting with those on the new state pension. If you reached state pension age on or after the 6th of April 2016, you are on the new system. The full new state pension currently stands at £221.20 per week. From April 2026, this will rise to £230.25 per week. That is an increase of £9.05 each week. Over a month, that works out to approximately £39 extra. Across a full year, you will receive around £470 more than you did in the previous tax year. To put that in perspective, this extra money could cover a couple of months of council tax for many pensioners, or help with several weeks of grocery shopping. It may also ease the pressure on household energy bills, particularly during the colder months. However, there is an important point that catches many people out. Not everyone receives the full new state pension amount. To qualify for the full rate, you need 35 qualifying years of national insurance contributions on your record. If you have fewer than 35 years, your pension is calculated proportionally. For instance, if you have 30 qualifying years, you receive 30/35ths of the full amount. That would currently be around £197 per week, rising to approximately £205 after the April increase. The minimum requirement to receive any new state pension at all is 10 qualifying years. If you have between 10 and 35 years, your amount falls somewhere in between. Now I want to address something that affects millions of pensioners, and it is often overlooked in headlines. If you reached state pension age before the 6th of April 2016, you are on the old system, which is called the basic state pension. The full basic state pension is currently £169.50 per week. With the 4.1% increase, this will rise to £176.45 per week from April 2026. That is an increase of £6.95 per week, or roughly £30 per month. Over a full year, the increase amounts to approximately £361. You will notice this is over £100 less per year than the increase for those on the new state pension. The percentage is identical at 4.1%, but because the starting amount is lower, the cash increase is smaller. This is an important distinction. The gap between the old and new state pension systems continues to widen with each passing year. Currently, someone on the full new state pension receives around £54 per week more than someone on the full basic state pension. That difference adds up to over £2,800 annually. If you are on the basic state pension, you may also receive additional payments on top of your basic amount. These are known as the additional state pension, sometimes referred to as SERPS, or the state second pension. These were earnings-related top-ups built up during your working years. The good news is that any additional state pension you receive will also increase by 4.1% in April 2026. So your total state pension income, including these additional elements, will rise accordingly. To know your exact figures, you should check your annual pension statement or contact the pension service directly. Let me now explain when you will see this increase reflected in your payments. The new rates come into effect from the 6th of April 2026, which marks the start of the new tax year. That date falls on a Monday. Your first payment at the increased rate will depend on your usual payment schedule. Most pensioners are paid every 4 weeks, and your regular payment day remains the same. If you typically receive your pension on a Monday, your first increased payment should arrive on or around the 7th of April. If you are paid monthly, your April payment will include the new higher rate. The increase happens automatically. You do not need to apply for it, fill in any forms, or contact the pension service. The Department for Work and Pensions updates your payment amount, and the new figure simply appears in your bank account. You should receive a letter in March or early April 2026 confirming your new weekly rate. This letter will show you exactly how much you will be receiving going forward. Even if this letter does not arrive, rest assured the increase will still be applied to your payments. However, I would encourage you to check your bank statement in April to confirm the amount is correct. While errors are uncommon, they do occasionally happen. Compare your payment to what you were receiving before and make sure the increase matches what you are entitled to. If you believe there is a mistake, contact the pension service promptly. The sooner any error is identified, the quicker it can be resolved. There is something many pensioners are unaware of, and it catches thousands of people by surprise each year. The state pension counts as taxable income. While you do not pay national insurance contributions on it, you may owe income tax if your total income exceeds the personal allowance. For the 2025 to 2026 tax year, the personal allowance remains frozen at £12,570. This freeze is set to continue until April 2028. Let me illustrate what this means with a straightforward example. If you receive the full new state pension of £230.25 per week from April 2026, your annual state pension income will be approximately £11,973. That figure alone is below the personal allowance, so you would not pay tax on your state pension by itself. However, if you have additional income sources, the situation changes. Suppose you also receive a modest private pension of £80 per week, which is around £4,160 per year. Your combined income would be approximately £16,133. Subtracting the personal allowance of £12,570 leaves you with £3,563 of taxable income. At the basic rate of 20%, you would owe around £712 in tax annually, which works out to roughly £59 per month. This tax is usually collected through the pay system and deducted from your private pension automatically. If that is not possible, HMRC will contact you to arrange payment. Because the personal allowance has been frozen while pensions continue to rise, more pensioners are gradually being brought into the tax system. This is sometimes called fiscal drag. Even if you have never paid tax in retirement before, you may find yourself doing so as your income increases. If you are uncertain about your tax position, you can check your personal tax account online through the government website or contact HMRC directly for clarification. If you are not receiving the full state pension, there may be an opportunity to increase your entitlement by filling gaps in your national insurance record. This is something many people do not realize is possible. You can check your national insurance record for free through the government website. It will show you how many qualifying years you have, whether there are any gaps, and whether those gaps can be filled through voluntary contributions. Each additional qualifying year you add could increase your state pension by around £6 to £7 per week. That may not sound substantial, but it amounts to over £300 per year, and you receive that increase for the rest of your life. Whether topping up makes financial sense depends on your individual circumstances, including your age, your health, and the cost of purchasing the missing years. For many people in their 60s with reasonable life expectancy, it can be a worthwhile investment. As a general illustration, if buying a missing year costs around £800 and adds £6 per week to your pension, you would recoup that cost in approximately 2.5 years. Every year after that represents a net gain. Additionally, because the triple lock increases your state pension annually, that extra amount grows over time as well. If you want personalized guidance on whether topping up is right for you, the Future Pension Center can provide a calculation based on your specific record. Alongside the state pension increase, pension credit is also rising by 4.1% from April 2026. This is an important benefit for pensioners on lower incomes, yet it remains significantly underclaimed. Pension credit tops up your weekly income to a guaranteed minimum level. From April 2026, this will be approximately £227 per week for single pensioners and around £346 for couples. If your income falls below these thresholds, you may be eligible to claim. Even a small amount of pension credit can unlock access to other valuable support, including help with housing costs, council tax reduction, and free NHS dental treatment. Estimates suggest that over 800,000 pensioners who are entitled to pension credit are not currently claiming it. Collectively, that represents nearly £2 billion going unclaimed each year. If you think you might qualify, I would encourage you to check. You can use the online calculator on the government website or call the Pension Credit Helpline. Claims can be backdated for up to 3 months, so there is no disadvantage to checking your eligibility now. For those who have not yet started claiming their state pension, there is the option to defer. This means delaying when you start receiving payments in exchange for a higher amount when you do eventually claim. Under the current rules, for every 9 weeks you defer, your state pension increases by 1%. Over a full year, that works out to just under 5.8%. So if you defer for 12 months, your pension would be nearly 6% higher for life. Deferring can make sense if you are still working and do not need the income immediately, or if you have other resources to draw on in the short term. However, it is not the right choice for everyone. If you need the money now, or if your health means you may not benefit from the higher payments over the long term, claiming straight away is likely the better option. You do not need to notify anyone if you wish to defer. Simply not claiming your state pension when you reach state pension age means it automatically defers. When you do eventually claim, the increase is calculated based on the length of your deferral. One important point to be aware of: you cannot backdate your claim by more than 12 months. If you defer for an extended period and then forget to claim, you could miss out on payments you were entitled to. The triple lock has protected pensioner incomes for over a decade, and it has delivered some significant increases in recent years. The April 2024 rise of 8.5% was one of the largest on record. While the April 2026 increase of 4.1% is more modest by comparison, it still exceeds inflation. This means your state pension is maintaining its purchasing power relative to the cost of living. Looking ahead, it is worth understanding that the triple lock is confirmed 1 year at a time. The government announces the rate each autumn for the following April. So while the 4.1% increase for April 2026 is locked in, future increases will depend on how inflation and earnings perform in the coming years. Both major political parties have expressed commitment to maintaining the triple lock, recognizing its importance to millions of pensioners. However, the policy does come at significant cost to the Treasury, and there are ongoing discussions about its long-term sustainability. For now, the triple lock remains in place, and pensioners can plan on the basis that their state pension will continue to rise in line with prices, earnings, or by at least 2.5% each year. If you are considering retiring overseas, or if you already live abroad, there is a crucial rule you need to be aware of regarding state pension increases. Your state pension can be paid to you in most countries around the world. However, whether it increases each year depends on where you live. If you reside in the European Union, the European Economic Area, Switzerland, or certain other countries that have social security agreements with the UK, your pension will continue to rise annually just as it would if you were living in Britain. However, if you move to countries including Australia, Canada, New Zealand, or South Africa, your state pension is frozen at the rate it was when you left the UK or when you first claimed it. You would not receive any future increases, including the April 2026 rise. Over time, this can result in a substantial difference. A pensioner who retired in 2016 and moved to a frozen country would still be receiving around £155 per week, compared to over £230 for someone in the UK. That gap of £75 per week amounts to nearly £4,000 per year. This is an area where the rules have faced criticism, and there are ongoing campaigns calling for change. But as things stand, the frozen pension policy remains in effect. If you are planning to spend your retirement abroad, make sure you understand how it would affect your income before making any decisions. Let me bring together the key points from today's update. The state pension is increasing by 4.1% from April 2026, confirmed under the triple lot guarantee. For those on the full new state pension, this means an extra £9.05 per week, or approximately £470 per year. For those on the full basic state pension, the increase is £6.95 per week, or around £361 annually. The new rates take effect from the 6th of April 2026. Your first increased payment will arrive according to your normal payment schedule, and the change is applied automatically without any action required on your part. Remember to check your bank statement in April to confirm the amount is correct. Keep in mind that the state pension is taxable, and if you have other income, you may owe tax on part of your pension. If you are not receiving the full state pension, review your national insurance record to see if there are gaps you can fill. And if your income is modest, check whether you qualify for pension credit, as this could provide valuable additional support. The key date to remember is the 6th of April 2026. You should receive written confirmation of your new rate in March or early April. If you have any concerns or questions about your pension, the Pension Service is available to help. Thank you for taking the time to understand these important changes. Staying informed about your pension entitlements helps ensure you receive everything you are owed and can plan your finances with confidence.